At renewal, an enterprise software provider expects the AI feature to pay for itself. The module reduces labor in complex cases, and finance sees room for margin expansion. Keep price flat and savings flow through. Raise price modestly and the customer still receives lower total cost of ownership. Procurement does not accept that model. The customer treats the feature as the new baseline. Before renewal proceeds, the account team is asked to confirm that contract value will not increase. The provider changed delivery economics before it changed contract economics. That is the pass-through problem in AI economics. AI can change delivery cost without creating equal pricing power. Renewal terms, competitive parity, and usage behavior decide how much of that change reaches the margin line. AI cost does not behave like the labor cost it replaces. An AI capability adds committed infrastructure, monitoring, evaluation, maintenance, and marginal inference. Some cost rises with usage. Some remains in place whether usage is high or low. The expense follows usage at the margin, but the capability has to be financed before usage arrives. A simple relationship sketch clarifies the economics. The old model is labor and legacy support. The new model is lower labor plus an AI infrastructure layer. Pricing sits beneath both. Subscription fees, usage fees, renewal uplift, or packaging. The margin line receives what remains after unrecovered infrastructure cost, negotiation leakage, competitive pressure, and unbilled inference. The margin benefit is the residual, not the headline saving. Pass-through becomes difficult when pricing is tied to seats, annual commitments, or bundled access. High engagement customers can consume more AI processing under contracts built around minimum commitments. The most valuable accounts can become the hardest accounts to price. A second constraint appears on the customer side. In US enterprise markets, buyers evaluate total cost of ownership. If the feature requires validation, workflow redesign, data cleanup, or training, the customer may see the provider's savings as transferred effort. That limits willingness to accept higher renewal pricing. The seller's cost reduction is not automatically the buyer's economic gain. Competition narrows the channel further. Early in a market, an AI capability may support a premium because it is differentiated. Once comparable functionality appears across vendors, procurement treats it as included capability. The feature shifts from price lever to retention requirement. The provider still carries infrastructure cost, but the customer no longer treats it as optional value. The economics shift from recovery to absorption. Here, the model becomes clearer and more constrained. AI lowers visible delivery cost in one layer, yet the economic result is determined later, during utilization, renewal, and pricing decisions. The saving appears first. The margin benefit has to clear later. The benefit holds only if realized price, customer usage, and capacity remain aligned. When one separates, cost displacement no longer converts cleanly into margin expansion. The pricing power weakens at the same moment the support obligation becomes permanent. The first failure point is utilization mismatch. The company maintains capability readiness, but usage arrives unevenly. If usage is too low, committed cost spreads across too few billable events. If usage is too high inside flat rate terms, marginal inference and oversight costs rise without matching revenue. The curve works only when billable activity rises faster than readiness cost and unbilled inference. The second failure point is renewal leakage. Sales teams may avoid explicit price movement to protect close rates. The AI feature becomes a concession inside the renewal rather than a monetized capability. The cost appears in operating expense, but the price increase disappears inside negotiation. Margin compression often enters through discounting, not product architecture. A rival can include similar AI functionality to win share before its own economics are proven. That forces the provider to match the market before infrastructure cost has stabilized. Costs arrive now, while pricing power may already be gone. The pass-through window can close before the cost base has matured. Providers respond with usage caps, premium tiers, or packaging boundaries. They limit consumption to protect gross margin. But lower consumption also reduces the utilization needed to spread committed infrastructure cost. The protection mechanism raises the threshold it was meant to defend. The provider is monetizing readiness, not just functionality. AI infrastructure also raises operating leverage. More cost is committed before revenue is realized. If realized pricing falls short, margin sensitivity rises. A small gap between modeled usage and actual usage can widen contribution margin variance because the company has already committed to readiness and support. The system becomes more scalable, but less forgiving. The practical test is whether pricing absorbs the new cost structure without leakage. Finance compares modeled labor displacement with realized contribution margin. It then separates the effect of renewals, discounts, usage, inference cost, oversight burden, and cohort behavior. If high usage accounts show lower margin despite higher value, the cost has been relocated into the margin line. Returning to the relationship sketch, margin receives only what remains after negotiation, competition, and unbilled usage. High pilot volume can obscure the signal. Pilots prove value before volume is high enough to spread committed infrastructure cost. They also condition customers to expect the feature before pricing is settled. The company exits pilot mode with a stronger product and weaker monetization. The capability has been validated before the economics have cleared. Cost pass-through depends on three alignments. The AI cost layer must vary predictably. The pricing model must attach revenue to the activity that creates cost. The market must still recognize the capability as differentiated enough to accept price movement. If they hold, AI cost changes can support margin expansion. If one fails, the same technology can create a feature customers value, competitors copy, and providers partially subsidize. The cost has not disappeared. It has become the margin exposure between what the provider must keep ready and what contracts can recover.